Had quite a few stocks pop up this morning on the scan as the market pulls back a little today. It's nice to finally be right on my weekly review, by the way. But today I would like to take a look at MDT. This is one I'm looking at for a couple of potential trades. At the end of the video, I'm going to go over what type of trades you could place in MDT. But first, I want to go over why I think that it's in a good place. First of all, these are stacked moving averages. You can see that we've got 200, 50, 30. 2010 all stacked. You've got good distance between them. Really this candle here was probably the better point to go long, but here we are today. We're just a little bit over the 10. You got a trend line from the weekly right through here. We want to take a look at now the wave, and you can see we're still in a decent buy zone at the wave. It gapped up this morning and sold off a little bit, which is a little concerning. But I still like where it's at for the trades I'm going to talk about today and the way that you can take advantage of it. But we still got the wave support here. Still got the trend line here. We're in a good place to buy. Like I said, the green candle here was probably better for Friday, but that's okay because remember, the market's selling off today. And there's not really a tremendous amount of weakness we're seeing right here. So that's a pretty good sign. RSI is a little high, but it's not too high. Take a look at the Bollinger Bands. A couple of things I want to look at here because it has to do with the type of trades I'm looking at today. Is we're below the 1 ATR band, so we are still in a buy zone if we wanted to go long. We do have some trends that we can rely on and got some support on these Bollinger Bands. You can notice at the TDM squeeze indicator that we're losing some momentum, which is not a bad thing necessarily since we are in a buy zone. Now let's talk about different ways we could trade this. Many times when we start getting a little bit of consolidation and losing some momentum on the TTM squeeze indicator, I find it as a good opportunity to short an iron condor because I would expect that contraction to continue a little while before it made a sudden move in any direction. So that's the first thing I want to take a look at is what a short iron condor would look like. And what I did here is I went out about 32 days because I like to usually sell them at 30 to 60 days. I went ahead and shorted the 109 put, which was at a delta 21, and the 118 call, which is at a delta 21 also. I went 2 strikes out, so it's a $200 risk, but I'm getting a $58 credit, which is really good on that 2 wide spread you have there. So really your overall credit, or your overall risk here is about a little under $150 on this trade because you're getting a $58 credit. We look at the risk profile. You can see at expiration, we're looking at about a 54.62% chance of success on this if we're trying to hold it to the end. One thing is implied volatility is a little bit low, so we're not getting a great credit overall because I would like to have this at about 60% or higher. So that's a little concerning for me. But I've got a good credit here, and I really could probably expand it further. But let's look at the chart of where our break-evens are if we do this trade. I'm going to look at on the wave chart. On the downside, our break-even is right here at about the 108.50, roughly in that range. So you've got the whole wave as support, and you've got this Keltner line as support, plus two trend lines. On the upside, it's about 108.50. Based on the way the market's been trading lately, I'm a little more concerned about this one because you've only got this one Keltner line to give you a little bit of resistance as you head up toward there. On the Bollinger Bands, you can see, though, you do have 3 Bollinger Bands to try to give you some resistance to protect this position. So that's not a bad trade. If I did enter this trade and I were able to get a 58-cent credit, I'd probably look to close it, put a good cancel order out for about half this. You could go a little higher than half, but I'd probably go for about half, which would also increase your probability of success. Another trade you could look at, because I am expecting this to be a buy zone and a move back up, you could look at selling a credit spread, a put credit spread. And what I did, I drew a line right here on where I would expect to find support, which is basically this price level here. If it were to break this, I'd probably close this credit spread for whatever loss or gain I had at the time. And if it goes up, then we just see where we ended up there. But let's look how that would look. I looked at selling the 113 short put and then covering it with the 110, which gives me an 80-cent credit or an $80 credit on a $300 risk, which really is about a $220 risk on an $80 credit. That's not great. Even if you kept it to expiration, that's only a 36% return. And we're 18 days out, which is a little further out than I would like to trade these. I really like to be around the 14-day range on a credit spread like this. So honestly, I'm not overly happy with this result here. We can take a look at the risk profile going out to the 17th, just to give you an idea of what the computer says your percent probability of success is, and it's about 58.87. So you do have a overall higher return or potential return, but really you have more risk. Again, you're $220 here. This is not a great return because in order to do this the way that I typically trade it, I'm going to try to close this at about 40 to 50% of my credit. So I'm only going to be trying to get between 40 to 50 cents on this at the most, and I've got a $300 risk, which is not a great risk return. If it did break below this line here, then this one around the 112 area, probably a little below there, maybe 111.87, that I would go ahead and close this trade. It is a trade you could do, but it's not one that I'm overly satisfied with as I look at the risk return on it. The last trade I want to take a look at would be a call calendar, going along my call calendar trade. I do like calendars, trade them quite often, and I'd probably be looking at around this 114 range if I wanted to do a calendar here. Take a look at that. I would short this 3 January, which expires on the 3rd, which is 4 days from now. I really like this because we have a holiday in between, so it's like getting a little bit of free time decay. And then I'd go ahead and probably buy the 31 January, 32 days out, 114. Right now we're looking at about a $1.46 debit, which is not bad for that many days out and for where you're at. And I would almost trade it the same way that I would trade the credit spread, in that what I would do is I would really pay attention to a break of this line here at the 111 or at the 112 range. And if we were to break that, I would go ahead and close the calendar for whatever gain or loss was out there. Other than that, I'm getting a dollar. So I'm getting a $1.50 credit now. It's gone up a little bit. I would set a good to cancel order for about $1.90, $1.87, somewhere in that range. Really, I'm just trying to hopefully get out, to let all of this 114 expire and still have some value here, so I can get out at about $1.85 to $1.90 range. And that would give me about a 25% return. The only real danger with the calendar is if it did go up to say 116 by Friday, which I don't think it will, looking at what we've got going on here. But if it did do that, then you could potentially get a little bit, you could get a loss even though you're right on the direction. So that is a little bit of a danger when you place a calendar. I do like them. I trade them quite often. And really on this particular one, I would really look strongly at either the shorting that iron condor or doing the calendar. I think those are probably the two best options here. You could also buy a call or do a call debit spread. I think even that would be a better option than selling the credit spread. You could do a naked call, or I'm sorry, a naked put down here around, we'll say 112, and let's see what that would bring in. You'd have to do it probably on 18 days out. So you bring in about $100. If you went to the 111, you could probably get around $80 on that one. But you're going to have a lot more risk, so your actual return will be lower. I would probably, personally on my account, I would prefer that to doing the call credit spread most of the time. However, because this is Medtronics, you can get some wild fluctuations, and I typically prefer to do naked puts, naked calls, or strangles on more consistent stocks, higher volume stocks that are affected a little bit less by random news. So I probably wouldn't trade that here, but if you're feeling aggressive, I guess you could. But I would really look at that calendar, and I would also take a strong look at maybe a debit spread if you wanted to trade whatever they call credit spread. If you have any questions, let me know. If you have any comments, please let me know those. Please like the video. Please subscribe to the channel, and I'll talk to you next time. Thanks.